Welcome to the Deep Dive. We're your essential briefing on the big shifts in the global market.
And today, we're really digging into LVMH, their Q3 2025 sales results, and that investor call on October 14th.
Yeah, there's a lot to unpack there. The market certainly reacted strongly.
It really did. And this deep dive is crucial for you because, look, LVMH didn't just give us numbers. They signaled a pretty major inflection point. That huge rally afterwards tells you the street was basically bracing for much worse, especially on China.
Right. So our mission today, understand what actually drove this, well, unexpected return to growth.
Exactly. We need to dissect the sort of dramatic divergence happening across their businesses and pinpoint those headwinds management warned us about for Q4. It's a critical quarter coming up.
Okay, let's start right at the top then. The headline takeaway. LVMH had been stalled for what, over a year?
Pretty much, yeah.
But Q3 broke that streak. Revenue came in at $18.28 billion.
A solid number. But the figure that really moved the needle that sent the whole luxury sector higher wasn't the total revenue itself. It was the organic growth.
Plus 1% year over year. That's the first positive quarterly organic growth we've seen from them all year.
Precisely. And you have to understand, that single digit is fighting some serious gravity. This is where the context gets really interesting.
Go on.
LVMH's reported sales, what they actually booked in euros, were down 4%.
Okay, so how does that square? 1% organic growth, but down 4% reported.
Currency. They faced a negative 5% FX impact just in Q3. Foreign exchange.
Wow, 5%.
Yeah. Mostly that strong euro making things expensive everywhere else. So that organic 1%, that's the underlying operational health. And it's battling a huge currency drag.
That's a really crucial distinction for listeners to grasp, but even with that positive sign in Q3, we should probably zoom out slightly. The year-to-date picture, the first 9 months.
Right, the 9M25 print. Revenue there is $58.1 billion. But it's still down 2% organically for the year so far.
So Q3 is definitely a turning point, a shift in trajectory maybe, but we're not talking full steam ahead recovery just yet.
Not at all. And actually, when you dig into how they got to that plus 1%, you see it's a story of, well, extreme bifurcation. That's maybe the key takeaway for you here. The recovery is super uneven. Some divisions are doing immense heavy lifting.
Okay, let's break that down then. Where did we see the real momentum? Who carried the weight this quarter?
The clear standout, the star performer, was Selective Retailing. It accelerated dramatically, posted 7% organic growth.
7%. And that's mainly driven by?
It's basically the Sephora story continuing. Management called Sephora's performance very strong. They're growing it like twice the market rate, still grabbing share.
Impressive.
And you also saw some stabilization in their travel retail side, the DFS business, that's linked to traffic picking up in places like Macau and Hong Kong.
Okay, so Selective Retailing is pulling hard. What about the middle ground? We saw some stabilization there too, right?
Yeah, exactly. Watches and jewelry and perfumes and cosmetics both landed at positive 2% organic growth, a definite improvement.
Let's look at watches and jewelry. What's the sort of flavor of that growth? Was it more volume or more price and mix?
Definitely more mix-driven, which tells you something interesting about the customer, I think.
How so?
Well, Tiffany, for instance. They saw a strong acceleration in the U.S. and actually record sales in high jewelry. So the growth came from those iconic, very high-value sales.
The top end is strong.
Scary. And crucially, it also came from their own efforts, what they call self-help. Renovated stores, which are now 30% of the network, are apparently way more productive. But the underlying traditional watch segment, that was still slightly negative overall.
So that really highlights that divergence, doesn't it? The super high end is spending big on unique pieces, maybe iconic items, but the, let's say, aspirational luxury watch buyer is still a bit cautious.
Perfectly put. And then you had wines and spirits, also stabilizing. Came in at 1% organic.
What drove that?
Mostly champagne and rosé wines. Seems like there was some restocking in the U.S., and demand held up pretty well. Cognac, though, still the weak spot, down 6%.
Still down, but was there any improvement?
Yeah, there was, yeah. Sequentially better, apparently due to some VSOP restocking over in China. So signs of life, maybe, but still dragging.
Which brings us, I suppose, to the elephant in the room.
Fashion and leather goods. FNLG.
LVMH's biggest, most critical division, $8.50 billion in revenue just this quarter. And yet,
it was down 2% organically.
That's a really stark contrast to, say, Selective Retailing or even the stabilization in the other divisions.
It really is. And interestingly, While the watches and jewelry growth was about mix, management specifically noted that the sequential improvement they did see in F&LG,
Hmm.
it came mostly from better traffic and volume, not from big price hikes.
So that suggests maybe that getting people back in stores is happening, but converting that into higher average spending or overcoming volume pressure, that's still the challenge there.
I think that's a fair reading. The volume pressure seems real even if footfall is looking a bit better.
Okay, let's pivot to geography then, because a big part of the market reaction seemed tied to news out of Asia.
Yeah, absolutely. That was probably the biggest positive surprise for the market. Mainland China demand, it officially turned positive in Q3.
Turned positive. What kind of numbers are we talking?
Management said mid to high single-digit growth for local Chinese customers. That confirms that local resilience story we've been tracking.
Okay, so the local Chinese customer is spending again. What about the Chinese tourist spending globally? That's always been a huge factor.
Right. So the overall Chinese cluster that's local spending plus their tourist spending worldwide is now close to stabilization. It's still low single-digit negative, but it's getting less negative each quarter.
So improving trend, but not quite there yet.
Exactly. Tourist purchases specifically are still declining double digits, but again, the rate of decline is slowing down. That's key.
And elsewhere, the U.S., Europe.
The U.S. saw solid growth, also improving sequentially compared to Q2, which is good news. Europe, though, remained broadly stable, but definitely softer. Hit by tourism slowing down a bit, and of course, that strong euro making things pricier for visitors.
It sounds like, given this uneven picture geographically and by segment, LVMH isn't just riding a recovery wave. It feels like they're actively pushing things forward themselves, the self-help idea you mentioned.
Oh, absolutely. That was a major theme on the call. Their core strategy seems to be invest right through the cycle. Keep pouring money into brand desirability, even if it pinches margin short term.
And how are they doing that? What are the levers?
Well, creative renewal is huge. They highlighted Dior's new look. The men's collection hit stores in January, women's in Q2. Plus, you've got new creative directors just announced at Celine and Fendi. These are things they expect to be catalysts going into 2026.
And I saw something about retail innovation, too. That seemed really interesting. They mentioned a specific initiative in Shanghai.
Ah, yes, the Louis in Shanghai initiative. It's a great example of their focus on high-profile experiential retail.
What was the story there?
Apparently, it quickly became one of Louis Vuitton's absolute top-selling locations globally for high-value items like suitcases. Sort of proves their theory.
Yeah.
You create these amazing experience-led retail spaces in key locations, and it drives those really big transactions.
Makes sense. Connecting the experience directly to the sale of high-ticket items.
Exactly. And you see Tiffany doing the same thing with their big push on store renovations again, boosting the experience, boosting productivity.
They're also creating whole new categories, aren't they? Like the Louis Vuitton beauty launch.
Right, La Beauté Louis Vuitton.
Yeah.
Launched with, I think, 55 lipsticks. It extends that powerhouse brand into beauty, running alongside Sephora's, massive dominance in that space.
So lots of investment, lots of initiatives. But this presumably leads into the more cautious parts of the message. What did they say about guidance?
Well, typically they didn't give any hard numeric guidance. But the CFO definitely struck a cautionary tone, particularly about Q4. He warned it's going to be tougher.
Tougher than Q3. Why?
Two main reasons flagged. First, tougher comparisons or comps.
Okay, break that down. What does tougher comps mean for the listener?
It just means they're comparing their performance in this upcoming Q4 against a really strong Q4 from last year, 2024. The CFO explicitly mentioned a 4-point tougher comparison for the whole group across Asia, Europe, and the US.
So even if they improve sequentially from Q3 to Q4 this year, getting positive year-over-year growth is just much harder because the benchmark from last year was so high.
Exactly. It sets a much higher hurdle to clear for positive growth.
And the second headwind for Q4.
Currency again, that FX drag.
Yeah.
It's expected to be even stronger than the negative 5% they saw in Q3.
Ouch. So the macro pressure isn't letting up there.
Doesn't look like it. And LVMH's response to this pressure is really key to understanding their philosophy. They basically doubled down on their commitment to keep investing.
Investing in the brand desirability, the retail execution we talked about.
Right, even if it pressures margins in the short term. They were pretty clear. Margin stabilization requires getting back to sustainable, positive top-line growth first. They're not going to slash investments and risk hurting the brands long term just to hit a quarterly margin number.
Okay, so zooming out again. For you, the investor listening, what does this all mean? Why did the market react so positively if Q4 looks tough and F&LG is still lagging?
Well, I think the market was basically priced for Armageddon, especially on China. So the fact that mainland China stabilized and turned positive locally, that was huge. It suggests the sort of U-shaped recovery narrative might actually be intact.
Supported by that local customer resilience in China and the US.
Precisely. And it also validates that divergence we talked about. The high net worth customer is still spending on unique, high-value stuff, even if the core FNLG volume remains the big test.
And looking further ahead, management seems to be trying to set the stage for 2026, right?
Yeah, they pointed out that the comparison base should get easier in the first half of 2026. Combine that with the expected impact from those new creative cycles hitting stores Dior, Celine, and they're definitely building a narrative for a potential reacceleration next year.
Interesting. Did they touch on M&A or the overall portfolio at all? They have so many brands.
Briefly, they basically said there's no dogma about the current 80-plus brands. The priority is always assessing assets for talent and brand fit. It ties back to that focus on creative leadership. They see brands as platforms for great talent and unique products.
Got it. But the immediate hurdle, the thing to watch right now, remains Q4. Can that Chinese local demand stabilization really offset those tough comps and that worsening FX drag they flagged?
That's the million-dollar question, isn't it?
Okay, it's time for our This Is Not Financial Advices segment. We try to connect the dots from the call to maybe a speculative idea.
A thought experiment, if you will.
And a key theme from this call was definitely the power of innovative, high-touch retail experiences. You mentioned Sephora's share gains, Tiffany's store revamps, that Louis in Shanghai example.
Right. It feels like the experience economy side of luxury is helping stabilize things, maybe even before the core handbag business fully recovers volume.
So given that observation and that stark operational divergence we discussed between the segments, what's the potential play here?
Well, again, purely for discussion, not advice. You could think about a targeted, maybe longer-term spread trade. It's essentially a bet on that operational outperformance we're seeing in certain areas.
You mean betting on the segments most leveraged to that experiential retail and product innovation?
Exactly. Betting on those over the largest segment, FNLG, which seems still more tied to the broader macro cycle and maybe some volume headwinds.
Okay, so spell it out. What's the trade?
You could consider being long a basket of selective retailing in watches and jewelry, and simultaneously short fashion and leather goods, FNLG.
Right. Long the stars, short the laggard, basically.
Yeah. Kind of. The rationale is you're betting that the retail excellence, the brand heat from renovations and high jewelry, the Sephora engine, all that self-help stuff that's already delivering will drive value faster than FNLG can fully shake off the macro pressures and, potential price fatigue.
So it's a bet on LVMH's operational breadth and innovation outpacing the recovery in its core driver.
That's the idea. Leveraging the confirmed strength against the areas still facing the biggest questions. But again, we absolutely must stress this is purely a theoretical discussion, not financial advice in any way.
Understood. Okay, let's wrap this up then. To recap the core message, LVMH delivered a really critical return to growth in Q3, plus 1% organic.
Fueled largely by that vital local demand stabilization, especially in China and the U.S.
But achieved despite those significant headwinds from FX and softer tourism.
And facing even tougher comps in FX in Q4.
So the key question we leave you with is this. Can LVMH's continued, pretty aggressive investment in creativity and that high-cost experiential retail actually generate the sustainable volume growth needed, particularly in H1 2026?
Especially given management explicitly linking margin recovery to getting that top-line growth back first. That gap between the heavy investment now and the volume needed later, that really remains the central tension to watch.
A lot to think about there. Thank you for joining us for this essential deep dive into LVMH's latest results. We hope we've helped distill the complexity down for you.
Yeah, hopefully this gave you the quick, thorough insight you need to understand what's really driving things at one of the world's most important companies.